The tax-free savings account, or TFSA for short, is Canada's most popular and widely utilized registered investment account used for emergency savings, investing towards large purchases, and saving towards retirement. That's going to hit over $100,000 worth of total eligible contribution room as of 2025. Introduced in 2009, the TFSA has now been around for over 15 years, adding cumulative contribution room each calendar year for Canadians above the age of 18. Now, it should be noted that the Canada Revenue Agency, CRA, is yet to announce the 2024 indexation rate for personal income tax and government benefits. And it's this rate that also determines the annual TFSA contribution limit and tax brackets. Now, keep in mind that the annual TFSA contribution limit is set at a base amount of $5,000 per year, then adjusted for inflation each year since the TFSA's introduction in 2009, and then rounded to the nearest $500. So this would mean that the inflation-adjusted TFSA limit for 2025 would be around $7,044, up from $6,859 in 2024. And it's for this reason that it is highly likely that this amount will be rounded to $7,000 to align with the nearest $500 increment. So expect the 2025 TFSA limit to be $7,000 once again. TFSA contribution room begins to accumulate the year a Canadian turns 18, even if they don't open a TFSA. For instance, someone who turned 18 in 2023 and has yet to contribute would have $13,500 in total contribution room as of right now in 2024. And if they don't make any contributions in 2024, their TFSA room would increase to $20,500 in 2025 because we're adding $6,500 to $7,000 and $7,000 again for that total $20,500 in 2025. So here are the TFSA dollar limits by year dating all the way back to 2009, where we can see a gradual incline over the years, except for 2015 that had a $10,000 annual contribution limit. This effectively means that if you have been 18 since before 2009, well, as of 2025 with an additional $7,000 annual contribution limit, you'll be looking at a total of $102,000, up from $95,000 in 2024. So it's quite simple to calculate your own TFSA contribution limit. All you need to do is tally up the annual limits from the year in which you turned 18. If you turned 18 in 2008, you'd have a limit of $102,000. If you turned 18 in 2015, well, then you'd have a limit of $71,000. And say if you turned 18 in 2022, you'd have a limit of $26,500, all of which, again, as of 2025. And alternatively, you can just log into your MyCRA account and view your official limit there as well. But keep in mind that if you've made several contributions and withdrawals in a short period, this may not be up to date at all times. Also to note is that you only gain contribution room in years where you're a resident of Canada. So if, for example, you're entitled to the full $102,000 limit because you were born before 2009, but say between 2016 and 2018, you're not a resident of Canada, then your contribution room would not include the $16,500 contribution room from those years. So you'd be looking at a total contribution room of $85,500 instead. Now, it's important to always remember that while contributions to a TFSA are not tax deductible, withdrawals of contributions and growth from the account are going to all be tax-free, because the logic here is that you've already paid tax on the money that you're using as contributions to the account. Unlike, for example, the RRSP, where, yeah, your withdrawals are tax deductible in the year for which you made those contributions, but down the line when you make withdrawals from the account, that does count towards taxable income. So it's essentially the opposite of the RRSP in this respect. And this means a retiree could say withdraw from their TFSA without increasing their taxable income for that year, which might otherwise affect their access to certain benefits such as, say, old age security. Alternatively, it means that if you hit big on an individual position held within your TFSA, well, it is entirely exempt from tax. However, the only caveat is that you can't day trade in a TFSA. That goes against the CRA's rules. although moderate trading activity is definitely no cause for alarm. Another thing to consider is that when a TFSA holder makes a withdrawal in a given calendar year, they'll receive an equal amount in TFSA contribution room in the following year. And this is going to be in addition to that new contribution room for that year. And the reason for this is because you're allowed to recontribute amounts that you've withdrawn, of course, but not in that same calendar year if you've already made that contribution and you have no room left. For example, let's say your TFSA balance is maxed out at $13,500 in 2024 because you turned 18 in 2023, and then you decide to withdraw $5,000 in 2024. Well, when January 1st, 2025 rolls around, you will be allowed to make that contribution once again of the $5,000 that you withdrew, plus the additional $7,000 in annual room that you're gaining in 2025. And the reason why you wouldn't be able to recontribute that $5,000 back to the TFSA in the same year before the next calendar year rolls around is because in the eyes of the CRA, you've already maxed out your allowed contributions of $13,500 up to that point, regardless of if you make withdrawals or not. And I mention this because if you're making several contributions and withdrawals in a single calendar year, well, where you're at in your allowed contribution room can get a little bit confusing, which may lead to over contributions and therefore interest penalties for the months in which you've over contributed. So generally speaking, it's advisable to view and use your TFSA as a longer term investment account where you're contributing to the account regularly up to your maximum contribution room and then limiting withdrawals to larger ticket items. But ultimately, it is of course your decision what you do with the account. Just avoid over contributions as you'll be faced with a 1% tax per month on the amount of the over contribution. For example, if you over contribute $500 for a 6-month period, well, you'd be looking at $30 in penalties. Hey, by the way, I'd like to take a quick moment here to speak about today's video sponsor, moomoo, which is a stock investment platform designed for both beginners, but also experienced investors. And it now serves over 22 million users in key financial markets, including the US, Canada, Singapore, and Japan. And in Canada, moomoo operates as a licensed broker regulated by CIRO, and it's also a member of CIPF, which ensures a secure trading environment for all of its users. And with its intuitive interface and robust data features, moomoo is ideal for newcomers to the stock market, allowing you to trade Canadian stocks, US stocks, ETFs, and options even, all within a single account. And the reason why moomoo is a great fit to mention in today's video is because they also offer Canadian registered investment accounts such as the RRSP and the TFSA, as we're speaking about in today's video. Moomoo offers real-time quotes, detailed data analysis, and access to company financials for all of the positions that you can buy and sell on the platform, along with analyst ratings and 24/7 financial news to help you make informed trading and investment decisions, all at zero extra cost to you as a customer. What's more is that moomoo has among the lowest FX conversion fees in the Canadian market at 0.09%, plus $2 per FX transaction, which can be used when buying stocks in US currency or simply converting funds in your account. In contrast, when using other brokerages to buy US stocks, the currency conversion fee is generally 1.5 to even 2.5%, meaning a $1,000 trade could very well result in fees of around $15 to $25. But in contrast to this, a $1,000 conversion on moomoo would only cost $3 in FX fee, which is extremely low. Finally, moomoo offers real-time market data, meaning you can see real-time price changes instead of relying on delayed data as with many other brokerages. And moomoo supports various international markets, which can allow you to broaden your investment horizons, along with their sign-up bonuses, where currently you can earn a 6% APY on cash sitting in your moomoo account, plus $200 in cash coupons and $2,000 in commission-free trading, which are all fantastic incentives to open an account. And if you transfer your investment account from a different financial institution over to moomoo at an account balance of at least $10,000, you will get up to $1,200 in cash rewards, which is a fantastic direct return on your capital. So make sure to open up a TFSA on moomoo today using my link down in this video's description to get the best sign-up bonus available. And with that said, let's get back to the video. Okay, let's now briefly cover 5 TFSA mistakes that are actually quite common, but that you'll want to avoid at all costs to maximize the account and avoid penalties. The first common mistake I've seen quite often is that many people treat the TFSA like a regular savings account rather than a tool for investment purposes. So although the name tax-free savings account can mislead certain beginners, and some companies do also offer interest on cash balances held in a TFSA, well, it's important to understand that a TFSA can hold stocks, ETFs, bonds, mutual funds, and other financial securities, not just cash deposits. So like I said, while some institutions do offer basic interest on TFSA cash deposits, this approach definitely limits the account's potential, and over time, this misunderstanding of how the account works could mean missing out on thousands of dollars in tax-free growth, as typical savings interest rates lag well behind the average returns of, for instance, the S&P 500 that you could be exposed to through a low-cost exchange traded fund held in your TFSA. The next mistake to avoid with your TFSA is not understanding that you can permanently lose or gain contribution room based on investment performance and then your withdrawal timing. So here's how you can lose room. If you turn 18 in say 2025, you'll have $7,000 in TFSA room. And say you invested all in a high risk stock that loses 80%, leaving you with $1,400. Well, if you withdraw that $1,400, then go spend it on say a down payment on a car, well, you can only then recontribute that $1,400 plus future yearly limit, because the CRA still considers your full $7,000 contribution used up for 2024. So contributing an additional $7,000 to, let's say, make back on your contribution room would actually create a $5,600 over contribution. So it's for this reason that utilizing exchange traded funds in your TFSA is generally a better solution for everyday Canadians that are looking to gain exposure to the stock market, as they're very passive and have proven to offer stellar returns on the average year. The next mistake to avoid is that many people contribute to a TFSA to save for big purchases or retirement, like buying a house, renovating, or getting a car. However, if you max out your TFSA contribution early in the calendar year, say in February, and then withdraw it in June for a car purchase, well, you can't recontribute that withdrawn amount until the next calendar year. That is, if your TFSA is maxed out. If you still have contribution room available to you, then this doesn't apply. But I mention this because if you're planning a large purchase throughout the year, well, it may be smarter to time your withdrawal for the end of the calendar year, or say in Q4. This way, you can recontribute that full amount as soon as January rolls around, maximizing your tax-free growth and reducing the opportunity cost of having your money out of your TFSA. Another common mistake is investing in a TFSA while you're carrying debt, particularly higher interest consumer debt. And this advice really applies to all investing, not just in a TFSA. Where I've had viewers ask if they should, invest in a TFSA while holding debt, thinking that the tax-free growth might, say, outweigh their interest costs. For example, paying 5% interest on a line of credit while hoping to earn 8% on an S&P 500 ETF, netting a 3% spread. And personally, here's the thing, I use lines of credit to invest in my real estate business at rates of 7 to even 12%, aiming for returns that do exceed that interest, which is tax deductible for business investments, by the way. But stock market returns aren't guaranteed, and with today's high interest rates that you're going to be paying on lines of credit, consumer debt often costs way more than the average market return. So in a low interest environment, investing while carrying debt may make sense, but with rates where they've been over the past 2 years, it's generally going to be better to eliminate consumer debt before investing in a TFSA or other accounts. All right, so that covers the TFSA moving into 2025. And if you want to learn more about properly navigating the stock market with not only the TFSA, but also the RRSP and other Canadian investment accounts, then make sure to sign up for my free stock market investing course over on Skillshare. There are over 2,000 students and 7.5 hours of curated content for you ready to watch. It is totally free, and I'd love for you to check it out if you're interested. So thanks a lot for watching. Make sure to use my link down below to open a TFSA on moomoo for low cost investing and nice sign up bonuses. And with that said, I will see you in the next one.